point out that you're seeing a pretty extreme overvaluation in junk bonds. Why is that, and how concerning is it?
Well, it's pretty concerning. The spread on BofA Merrill Lynch's high yield index is about 3.5 percentage points, 350 basis points. By our reckoning, it should be more like 5.5. And so a difference of 2 full percentage points is not the absolute greatest disparity that we've ever seen, but it's getting out there, and it's persisted for quite a while. And that's based on the overall risk, which is not just the default risk, but the risk as measured by economic indicators, the credit availability. It's also somewhat affected by the level of treasury rates. And when we've been at this overall risk, on average historically, the spread has been more like 5.5 percentage points. So you've got that possibility of a significant accident happening really just about any time.
We know that it's been tough for fixed income, certainly in the first half of this year, and high yield performed not as well as other fixed income classes, even muni bonds, for instance, doing better. Does that change now? What happens in the second half? And as interest rates start rising, how does the equation change for high yield?
Well, high yield gets advantaged by that. To the extent that rates are rising because the economy is stronger, that helps because the risk premium, default risk is reduced. And the disadvantage, as you say, in the first half was really related to lower treasury rates, and that's going to be a bigger help for longer duration assets. Generally lower yielding assets will have longer durations, and the maturities tend to also be shorter on the high yield bonds.